please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, some analysts earlier today, when we were discussing the rupee at 72.50, were pointing out that at the moment emerging markets have a kind of double whammy. Last time when the Fed was raising rates, it was, that is 2003 to 2007, the US economy was doing well and Asian economies could export to it. Now they have the negatives of the US economy doing well, which is a strong dollar and higher Fed rates, but they can't export as much because of the tariff war. Does this make EMs particularly vulnerable, and will that be the source of problems?
It makes them more vulnerable. I think this is a big source of uncertainty because many countries export to China and via China to the US. And this includes Latin America, it includes much of East Asia. Of course, India is different because it's more of a self-contained economy. But these are sources of vulnerability. And unfortunately, there is very little confidence that the US administration fully recognizes all these interlinkages and that it actually worries about the effects, the feedback effects, as the emerging markets slow. Now, the reality is much of world growth now is driven by the emerging markets. So the industrial world cannot be decoupled from growth in the emerging markets. We need both to grow if the industrial countries are to do well. We have an illusion, a temporary illusion, that the industrial countries are growing and growing strongly, and it doesn't depend on the growth in emerging markets. That's an illusion that will crack if, in fact, the emerging markets slow considerably.
Okay. These kinds of instabilities and trade tariff wars are coming at a time when US asset prices, stock market prices are very high, and so are Indian stock market prices. Are these particularly vulnerable?
Well, this is a consequence, in part, in the US of the added stimulus through the tax reforms, but also the still accommodated level of interest rates. US interest rates, despite growth being 4% plus in the last quarter, are still, the policy rate is pretty much zero at this point, given inflation. So, in real terms. So what this is saying is that the monetary policy rates will have to go up. And of course, that has a dampening effect on asset prices as we look forward. The broader point, I think, is this is something I've been saying pretty much since 2009, is that monetary policy cannot be the answer to all problems. And in the West, unfortunately, it has stayed very low for very long. It has built up vulnerabilities, and now as it normalizes, we are seeing the consequences of those vulnerabilities come about. This is unfortunately a consequence of the very low interest rates over a long period of time.